Should you refinance your mortgage? Interest rates are super low right now, so why not? In this video, you'll learn whether or not that's a good idea. Will refinancing your mortgage actually save you money? Stay tuned and find out. Welcome to Money Med School, where doctors come to learn about money. With all the chat today about how mortgage interest rates are super low, even 2% or less, you may be wondering if a refinance would be a good idea to save you money. Now, of course, you're probably like, Wagner, it's a no-brainer. If my current rate is 4% and I can get it down to 2.5, of course it'll save me money. Duh. It's true that lowering your mortgage interest rate will save you money. However, a mortgage is a bank product, and like the house, the bank always wins. What that means is that they're not going to just switch out your old high-interest loan for a new low-interest loan. They're going to charge you a few fees first. Sometimes the interest rate savings outweighs the fees. Sometimes they don't. Here's how to tell. Why do we refinance a mortgage in the first place? Well, two goals. One really, a lower interest rate. You pay less in interest, i.e. you have a cheaper loan. This usually lowers your monthly payment, especially if you go from a shorter term loan to a longer term. This can lower your monthly payment. That's nice, but that's not the main reason that you refinance. If you are having trouble making your monthly payments on your mortgage, then you probably have a little bit too much house and need to make some adjustments. But I'm not saying sell the house. If you love the house and you're willing to, make some adjustments elsewhere, so be it. Okay, so those are the main goals. The biggest goal is to get a cheaper loan. What goes into the cost of a mortgage? So these are the factors that can affect the cost of your mortgage. There's you stuff and there's bank stuff. You stuff includes your credit score, so make sure it's good because otherwise you're going to get jacked on your interest rate. There's no point in applying. Your income, the more money you make, nicer loan they're going to give you. Also, in parentheses, do you have a job? You got to be employed first or else they're not going to lend to you. Your income to debt ratio. So they want to see that you make a lot more money than you owe in debt. And are you going to live there? Is this your primary residence or is this a rental property or investment property? Those are going to affect the rates. How long are you going to live there? Are you planning to live there for one more year? Or are you planning to live 5 years, 10 years? Or are you planning to live there throughout the whole entire life of the mortgage? That's a really important question because you're going to see when we do the example that affects which loan product you're going to choose. Then there's the bank stuff. You got your bank fee, which is called an origination fee. This is technically what the loan or what the bank charges you to lend you money. So it's one of the many things they charge you. They charge you the interest rate, which is the cost of the loan. So you are paying a percentage of the principal as an interest rate, and that's one fee you pay for borrowing money. Another fee, a big bank fee that you'll see in mortgages is an origination fee, and so that's the fee they charge you for putting this whole mortgage product together. And I say product because a loan is a product. It's what the bank sells you. Okay, the length of the loan, meaning the term. The longer the length of the loan, the more you are going to pay because you're going to pay interest for a longer period of time. So it's more expensive. Why would you get a longer term loan? Who the hell wants to pay that for 30 years when you could pay for 15? Well, the longer loan reduces your monthly payment to kind of ease the burden of overpaying your loan and kind of make you take the edge off, make you forget a little bit that you're paying more over the lifetime of the loan in interest by giving you a slightly lower monthly payment. All right, then there's points and credits. Points are, it's a fee that you can pay upfront. It's added to your closing costs, And it's essentially you are purchasing a lower interest rate. You can get a lower interest rate and points, or you could get a higher interest rate and credits, meaning instead of paying more money at closing for points, you would actually get a credit or refund from the bank for taking a higher interest rate. And I'm going to show you an example comparing a loan with points, a loan with no points, and a loan with credit. So we're going to do a low interest rate loan with points, a middle of the road interest rate with no points and no credits, and a higher interest rate and loan with a credit. Well, if a mortgage refinance can save me money, what's the risk? The risks of a refinance include every time you refinance your mortgage, you are taking out a new loan. And that's a 15-year or 30-year term. So every time you get a new loan, you're signing up for another 15 to 30 years of repayments. Of course, you can be aggressive and disciplined and have your own plan and pay it off way faster, but most people don't do it that way, and they could be refinancing that mortgage until, they're having their 100th birthday party, lighting their birthday candles with the cigarettes. You know what I'm saying? You don't want to be paying a mortgage when you're in retirement. You want to keep your costs down. So you want to have this taken care of before retirement. Just keep that in mind when you're considering the term, i.e. the length of your repayment, and what your plan is for when you're going to pay that mortgage off. All right, we are going to do a little mortgage refinance comparison. I've drawn up a little example spreadsheet here. This is a completely made up example, so some of these numbers may not be totally accurate in terms of closing costs because I'm guessing, but the rest are pretty accurate. So let's say you currently have a 30-year fixed rate loan of $250,000 and your current interest rate is 3.9%. You've owned your home for 2 years, so that leaves you with 336 months left on your mortgage. And this is important, I'll show you in a moment. So you have applied for a refinance loan and the lender is giving you 3 different options. How do you decide which one is going to save you the most money? So the first option is an interest rate of 2.375. The second is 2.625 and the third is 2.99. And you're like, why am I having to listen to this tutorial? It's totally obvious. Why the fuck would you go with 2.99 when you can go with a 2.375? Hello? Well, that's what the lenders want you to focus on, is the rate. They also want you to focus on the monthly payment. Because when you're busy looking at the monthly payment and the super low awesome interest rate, the catchy supercalifragilistic super low awesome interest rate that lures you in and they market with, then you don't notice other things like origination charges and closing and loan costs. Okay? Those are things they don't want you to kind of notice and focus on. What they do want you to do is pay attention to these glamorous numbers here and your mortgage payment, monthly payment, and ignore all this shit over here in the loan costs area, okay? So this is why you have to do a comparison. And so just to back up here, there's 3 different offers here with 3 different interest rates. There's also another thingamajiggy here, points or credits. This first one here has the super low awesome rate of 2.375 and it offers you 1.95 points. Next one is 2.625, still awesome, with 0 points, 0 credit. And the third one is 2.99 with a credit of $3,900. Now, what are these things? Points are a percentage of the total loan value. And in this case, what 1.95 means is that you get 1.95% of this loan in points. So 250,000 times 0.0195 equals $4,875. And what this means is that you pay $4,875 when you purchase this loan product. I'm going to come back to that because this is going to go right over here. If you don't have any points or credit offered, it doesn't matter, put a zero in here. If you have a credit of $3,900 or any credit, the reason there's a negative number in front of it is because this is deducted from your closing costs. All right, so how do we compare these different loan products when we've got different interest rates and different points or credit or no points or credit? Well, what we do is we go on over here to our handy dandy mortgage professor dude, who just so happens to have a very convenient mortgage refinance comparison calculator. All right, now, before I get here, I want to just go back and tell you something else. APR, what is this? Annual percentage rate. So this is a percentage that includes the value of the interest rate and all of the other fees and loan costs. So what it does is it kind of gives you a way to compare different loan products with different lenders and different features. Because if you just compare the interest rates to different interest rates on loans, it's not giving you the whole picture. The APR incorporates extra loan fees and all kinds of whatnots. It allows you a way of comparing products. So if you look at a loan from another lender or another mortgage product and you want to know if the interest rates are comparable, really you're going to look at APR because that's telling you if this is, if the fees are higher or whatever. So it levels out the playing field by incorporating other costs and fees, like an origination fee, which is a fee that the bank charges when they issue a loan. All right, so going back to handy dandy mortgage professor dude, this guy right here, we just fill in our numbers. And what you'll see here is that the first thing it's going to ask you is information about you and your house. First of all, expected years in house. Why is this important when you're talking about a refinance? Well, if you're only going to be in a house for 2 years and the cost to purchase a refinance loan is pretty high, then and it doesn't reduce your monthly payment or your interest rates very much, then it's really not worth the cost of refinancing. And that brings me to another point. Refinancing involves costs. What are the costs? Closing costs. Here's an example. Ta-da! Closing costs. All right. What do closing costs entail? Costs of the loan. So these are what the bank charges you. Also bank charges, and then some legal fees and logistical fees, the taxes of your local government, and then insurance costs and property tax costs. So in this case, you see the origination charges are demonstrated as points, so a percentage of the loan amount. This could also be a flat fee. One nice thing about points is that they are tax deductible. Just like the interest on a mortgage payment is tax deductible, well, so is the interest, so is the points percentage that you pay. Then you have to pay for an appraisal fee. The bank needs to see this because this tells you how much your property is worth. They want to do a hard credit check on you. They charge $50 for that, or however much the bank charges, and in this case a flood certification. Then you've got your legal fees down here, so the title, closing letter, endorsements on the title, anything involving the title, notary fees, overnight fees, tax certificate fees, wire transfer fees, and then lender's title insurance, which basically it protects you in case there's a lien on the property that you own. When they run the title, and if they find that this property has a lien on it or anything that prevents you from owning it, but you already purchased it or you took out a loan on it, you're still responsible for that property, except now you don't have any claim to it. So the title insurance protects you against that. These are all nothing you do about it. This is just part of the closing costs. You can shop for that, meaning you can find an attorney who might do it for cheaper than they're offering here. But either way, you have to do it. Other costs, taxes and government fees. So these are based on your municipality. These are not federal taxes. These are municipality based. And then you've got prepaids, like you have to include your insurance premium, and you may need to pay mortgage insurance. Most doctor loans don't have that. That's the beauty of a doctor loan. But depending on what your lending status is, what kind of credit history you have, you may need to pay PI, but hopefully you don't. And then homeowners insurance is included with your mortgage payment. And depending on when your loan closes, like when your closing date is, you will have some prepaid interest on that. And then your property taxes are also on here. And that's based on where you live. So some places cost more than others. Escrow is the bank account that holds your money to pay your homeowner's insurance and your property taxes and mortgage insurance if you have to pay that. And so you'll usually, this is a deposit on that. And then other, God knows what this is. Fortunately, in this case, it's zero, but geez. So that means that when you actually close this deal and purchase your loan product, you owe, in this case, it would be $18,145. Okay? You can roll these closing costs into your loan as well. Some lenders will let you do that. So let me go back to handy dandy mortgage calculator, dude. All right, so every time you refinance, you have to pay closing costs. So there's a point where these break even, and that means you have to live in the house for a certain amount of time before your mortgage closing costs will allow you to break even. And this just depends on all these numbers we're going to put in. So I'm going to show you how to play with this a little bit. Let's just say we plan to be here for 5 more years. Okay, the rate of interest on savings, this is particularly special because if you look at the description here, it says this is the interest rate you could earn on the monies you spend during the period you are in your home. For most people, it would be the interest rate on a bank account or a money market fund, which is hilarious because, sorry, what's the interest rate on a bank account? Like nothing. Even a quote-unquote high interest savings at this point in time is like 0.01%. I think I made 82 cents on my interest from one of my money market accounts last year. I was really pleased with that. It was a very high earning experience. Anyway, in here, I don't even bother putting a bank account, interest rate or whatever, because I don't invest my money in a bank account. So I made it very generous, like conservative 5% here. That would be like if my money was invested in the stock market in a basic index fund over many years, on average, you may get 7% return, and I knocked it down a little here too. Let's say we get 5% on our investments. This means if we hadn't wasted this money on closing costs, we could have used it to invest and we'd get 5% on it. I think that's what they're getting at here when they ask this question. Next is your income tax bracket. I used 32 for this example. I think most of us are hovering somewhere in this range, high 20s, 32, 35 could be up as high as 37. It just depends what your situation is. And the current value of the house. So this house, let's say we got our mortgage for $250,000 2 years ago, and now the house is worth $300,000. All right, so the current loan is $250,000, but we've been paying this loan for 24 months. So our current monthly payment is $1,180. And 250,000. All right, so we owe $221,680. Handy dandy. $221,680. Okay, that's what we currently owe. The new loan would be for, let's just say $222. They do take it up, so. All right. This is why it's helpful to have a calculator, because you're comparing a partially paid off loan to a new loan that's a slightly lower amount than what you originally borrowed. All right, the current interest rate on our loan is what I say here, 3.9%. 3.9%. And we're comparing 3 different interest rates. So we've got our, let's start with our 2.375. 2.375. All right, the remaining term here, which is why I put that up here. Remaining term is 336 months. And the new loan term is going to be 30 years, which is 360 months. Expected additional monthly payment, we do not expect anything additional. Optional number of years, new loan is interest only. We're not doing that. Points, okay? Here's where the points comes in. Percent of loan. Now, we're not going to roll this into the loan because that just drags it out even further. You're just going to pay this money up front. So we're not going to check this box. Okay, and the first option, the 2.375 option, had points of 1.95. And what that means is 1.95% of the loan is what we're going to owe at closing, which in this particular loan was like $4,875. All right. Oopsies, I put it in the wrong box. 1.95. Next, all other closing costs. Okay, so this is what I was talking about here. So now, origination charges, aka points, is this amount, but you've got all this other stuff you got to pay for, you know, appraisals, credit reports, all the legal stuff regarding the title of the house, all of your taxes, and your homeowner's insurance, and your property taxes. These all go into your closing costs. So for this example, I'm just going to say, like, take a guess here and just say our closing costs are $6,000 at baseline. And if we go over to Handy Dandy, we'll put in $6,000 just to keep this example simple. Okay, next we come down here, mortgage insurance information. In this case, we do not need mortgage insurance because we be doctors, and that's, we don't have to pay that because, you know, we don't take out loans with PI. However, if you did, you'd enter that information down here. And typically, lenders want you to take out mortgage insurance if you cannot afford to put usually a 20% down payment on the loan, because they want protection in case you can't pay this loan off, since you haven't demonstrated you could pay 20% of it off. You know, they want to know that they're going to get their money. So that's what that insurance is. Anyway, doctors wouldn't have to deal with that. All right, now compute relative costs. Ta-da! Here we go. So we've got, you know, we're going to stay in here for 5 years, 32% income tax bracket, pre-tax rate of interest on savings, like that's, and then they do a nice after-tax 3.4%, so very modest conservative estimate. Current value of house, $300,000. Loan information, current loan, $221,680 remaining on this mortgage. New loan would be for $222,000. The interest rate from 3.9 on the old one to 2.38 on the new one. The terms of the loans here, 336 months versus 360. Monthly mortgage payment, $1,085. Now it's going to go down to $862 with the lower interest rate. And the points here. And this is what the points amount is. The deductible amount for tax purposes. Oh, I know why mine is higher, because I based it on 250. So if we go 22000 times 0.0195 equals 4329, just like they said. Okay, all right, 4329 points deductible for tax purposes, yes. Dollar amount of points paid in cash, 4329. Other closing costs paid in cash to lender, $6,000 that we made up. So the total amount due, total points, fees, and charges paid in cash is $10,329. This is what your closing costs will be when you purchase the loan product. Now, costs over a 5-year period. That's what we put in here. Upfront costs, paid in cash, points, closing costs, monthly costs, principal and interest. Loan interest on upfront costs, monthly costs, total costs. Okay. So over a 5-year period, you're going to pay $65,000 versus $51,000 in principal and interest. The new loan has $1,900 extra on upfront costs from the closing, and monthly costs are slightly lower. So then they take into account the fact that you may have some tax savings on this. So you'll have some tax savings due to your points, and less tax savings due to your interest, because your interest rate is lower, so you're not paying as much in interest. So you won't deduct as much from your tax return, but the thing is that you still save money, because you only get a deduction if you have a loss. So it's better to keep the money in the first place. Reduction in loan balance, here you go. You'll have a little bit greater reduction because you have a less interest, and then total cost offset. So what they do is they do all of that, and then they give you this very nice summary down here. Over the next 5 years, refinancing your existing loan will save you $876. And importantly, for refinancing to pay, you must stay in your house for at least 55 months. All right? And under 5-year refinance savings, we will put $876. 876. Okay? And months that refinance takes to pay off, 55. Long time. All right. So you see here I have 10-year refinance savings and 30-year lifetime of loan savings. So let's go back. And this is lovely. You just come back here, and now we're going to leave everything the same. We're going to type in 10 and compute. And now we see over the next 10 years, refinancing your existing loan will save you $10,863. Go back. We are going to look at it for 30 years. $50,435. $50,435. All right. So this loan with the snazzy 2.375 interest rate, 1.95 points. The estimated monthly payment of $972 versus what we currently pay $1,180. So we have a monthly savings of $208. Over 5 years, we save $876. Over 10 years, we save $10,863. And over 30 years, we save $50,435. We got to stay in the house for 55 months in order for that, refinance cost to pay off, so that break-even cost. And we are paying $43.29 plus our $6,000 of closing costs. So total closing costs are $10,329. All right, now let's compare this to our next interest rate of 2.625 with 0 points. We're going to go back to 5 years. 2.625, same loan amount, same term. This time our points are 0. We'll leave the other closing costs at $6,000. And let's see what we get here. $2,704 we save, and we have to stay in the house for 42 months in order for that to break even. And this is 0. And I have got to put this back to blue because that is driving me crazy. Okay. Next, let's look at 10-year refi savings for this. And thank you for leaving all the data in here because, I had to put that in every time. Mortgage Professor really has it down, right? All right, we save $11,664. Let's look at 30-year. Okay. Baseline 6,000 and it's 6,000. So this loan, slightly higher interest rate, slightly less monthly savings, 176 versus 208. But we save a lot more money over 5 years and 10 years, and not as much over 30 years. And I'll explain why that is in just a second. You don't have to take as long to break even, and your closing costs are less. The reason that this $48,000 is a little bit less than the $50,000 for the 2.375 is that over a long, long period of time, paying points can work in your favor. So if you're going to stay in a house for 30 years, it is better to pay the points up front sometimes because you're basically paying to lower your interest rate. And that can pay off. But in the short term, it does not pay off, as you see here, because you're handing over like $4,329 more at closing, which, as we all know, money now is worth money in the future, worth more than money in the future. So you're giving more away up front. And if you're only going to stay there for 5 or 10 years, your savings are not as much as they would be with the slightly higher interest rate and no points. All right, now, let's look at this last one here. It's 2.99. My God. Oh, they're just gouging us with these horrible interest rate of 2.99. I swear to God, in the 70s, people would have died if they saw interest rates like this. They would have been shocked. Even now, it's still a little bit shocking. So 2.99, but look at this, $3,900 of credits when you buy this thing. Let's see how that works out. Go to our trusty professor here. We'll go back to 5 years. And this time we're going to put in the old 2.99. Same amount, same term, 0 points in this one. And because we have that credit, we are going to do $6,000 minus $3,900, which is $2,100. So that is our closing cost right there. Let us see. All right, 5 years. Boom. 45.41. 45.41. And we only have to stay in the house for 20 months in order for that to pay off. Do I sense a trend? Well, let's find out. Okay, professor, what do we get after 10 years? 11,517. Closing in. Closing in on that one. Okay, 30-year lifetime savings. Wait for it. What's it going to be? Oh my God. 42,048. Let's see here. Okay, so we look here, this one here, the 2.99 price gouging interest rate from hell. Oh, the horrors, I just can't even. Okay, the estimated monthly payment is $10.53, so not as big of a savings versus your current payment of $11.80. You save $127. In 5 years, your savings is $4,541. 10 years, $11,517, slightly less than the 2.625 and slightly more than the 2.3751. Interesting. At 30 years, though, you can see how that higher interest rate has hurt you a little bit. So your lifetime savings and interest over the loan is $42,000 versus $50,435. And I should say, lifetime savings, these three are comparing the interest rate that you're looking at here versus your current interest rate of 3.9%. So what you see is that in the short term, the lower interest rate with the higher points is not so hot. $876 of interest savings versus $4,500 with the 2.99 loan. At 10 years, they start to get very close to each other, and then over 30 years, the 2.375 pulls ahead. And that investment of $43.29 30 years prior does get you this lower amount. But the 2.625 comes in real close at $48,495. So you're not even saving $2,000. And look here, you paid $4,329 and you didn't even save $2,000 here. So is that really a great deal? No. And once again, you paid more money up front. Like money today is worth more than money tomorrow, right? So you lost a little there. But look down here, the 2.99 over 30 years, you saved $42,000 of interest compared to if your rate was 3.9. You were also given a credit, you paid less here. So you paid almost $4,000 less for this loan. At the 5-year mark, you're really pulling ahead with this 2.99. So this is now when it comes into play is what is your plan? Are you going to keep the house for 5 years or 10 years or 30 years? Because if you're only keeping it for 5, this is clearly the winner. If you're keeping it for 30, I would not say this is the winner. I would say this is the winner. Because the difference in closing costs, like the savings here outweighs the savings between $48,495 and $50,435. That's why you need to do the fancy handy-dandy mortgage professor calculator, because it takes into account the time frame, the opportunity cost, the money you could have had in savings, the current loan amount, how much you still have left to pay, the new loan amount, what you're going to borrow, the points, the closing costs, all of those things. It takes them all into account so that you can effectively compare the different interest rate savings, the monthly payment savings, and the closing cost savings. And one other thing I want to point out here is that it says estimated monthly payment, and then I've got mortgage and escrow crossed out. Because the estimated monthly payment really is the mortgage and interest payment, which is, in this case, like $972, and also the escrow account payment, which is your property tax and insurance costs. So all of those add up. So what you see in estimated monthly payment is not completely accurately reflected here. It's going to be a little bit higher because you are going to have to pay your property tax and your homeowner's insurance on top of this. So, and for this example, I did not include those in the current monthly payment here so that we could compare them evenly. So just know that. And that's how you decide if you're going to refinance or not. If you found this video helpful, or if you enjoyed watching this very hilarious and fun romp through an Excel spreadsheet looking at mortgage refinance numbers, give this video a thumbs up and subscribe to my channel.